COVID-19 epidemic is still very active in Europe, but this should not disrupt the economic recovery, so activity should remain strong in 2022. A slowdown can be expected in the first quarter, but the high level of vaccination and the fact that the Omicron variant seems less dangerous argue for rather limited impact. Besides, governments will probably remain very active to support the recovery. We can also note that demand remains strong, supply chain issues are beginning to be resolved, and business investment remains at high levels. On the risk side, several issues make us vigilant. First, a sharp rise in gas and electricity prices affecting Europe and Asia could have a strong impact on production costs and public finances. Second, in China, the zero-COVID policy could slow down growth, even if the public authorities continue to help the economy. And finally, the return of inflation is becoming a major issue and will lead central banks to reduce their monetary support. Inflation returned to very high levels at the end of last year, especially in the US, but also in Europe. Even if these high levels could decrease in the short term, some factors suggest that inflation will remain strong. Wages are already increasing in the United States, and the rise in real estate prices should lead to higher rents. The key to the problem is the labor market, which is currently very tight in the US and in Europe, causing a labor shortage and maintaining the inflationary cycle. This year could be more volatile for equity markets than 2021. On the one hand, economic momentum remains positive, which should allow corporate earnings to continue to grow. Credit fundamentals are strong, corporate balance sheets are healthy, and the profitability of companies is high. On the other hand, central banks' monetary tightening should result in higher long-term interest rates, which could have an impact on equity markets. Valuations are high, especially in the US, but European markets remain cheaper and still offer opportunities.